Welcome to The Deep Dive. We're your guides today for a close look at the recent RWE AG first quarter 2025 investor and analyst call.
Yeah, we're going to break it all down for you.
Think of this as your shortcut to understanding the absolute must-knows from that conversation, the key results, strategic moves, and what management sees shaping the energy landscape.
Basically distilling the key nuggets so you get informed fast. It's always interesting to hear directly from companies like RWE navigating, well, everything involved in the energy transition.
Absolutely. This call definitely gave us a lot to dig into. So let's jump right in with the headline numbers for Q1 2025.
Okay.
RWE reported adjusted EBITDA of 1.3 billion euros and adjusted net income, 500 million euros. Now, adjusted EBITDA, if you're not, steeped in these reports, it's basically a way to look at operating performance before things like income and taxes.
Right. And those figures, well, they represent a pretty solid start to the year for them. What's particularly interesting and something management really flagged is they managed this despite facing really weak wind conditions across Europe during the quarter.
Which for them, that's a significant headwind, right? Especially in just 3 months.
Definitely.
And even with that Q1 impact, they actually confirmed their guidance for the full year.
Yeah, that signals they're pretty confident they can still hit those full-year targets, suggesting they saw Q1 maybe as a temporary blip already baked into their thinking.
Makes sense. Okay, so let's really unpack those Q1 financials segment by segment. That's where you really see the detail, like that wind impact.
Exactly. That's where the story is.
All right, unpack away. Where do we start? Offshore wind.
Let's start there, yeah. Offshore wind, adjusted EBITDA for that segment came in at 380 million euros.
Okay, and that was down compared to last year.
It was, yeah, down year over year. Primarily, it was those significantly lower wind speeds we just mentioned, especially across their European sites. Management said this led to a really striking 33% drop in generation volume compared to Q1 last year.
Wow.
And on top of that, they saw lower hedge prices hitting the earnings too. They even put a number on the weather impact alone.
Oh, really?
Yeah, saying it was around 150 million euros below what they'd normally expect from, normalized wind conditions in Q1.
150 million just from less wind. That really puts it in perspective. Okay, so with offshore facing those issues, did their onshore wind and solar segment manage to pick up some of the slack?
It did, yeah. This segment actually had a stronger performance. Adjusted EBITDA hit 496 million euros here.
Okay, what drove that? Was it new capacity coming online?
Exactly. Earnings really benefited from substantial capacity additions. They grew capacity, particularly in the U.S., went from about 9.3 gigawatts up to 11.2 gigawatt year over year.
That's a big jump.
It is. Plus, they saw higher hedge prices compared to last year in this segment. Although even here, the weak wind in Europe and lower European hedge prices did partially offset some of that gain.
Got it. So adding new generation really helped. What about their flexible generation assets, the gas plants and such?
Right, flexible generation. Adjusted EBITDA, there was 376 million euros. Now, this was lower compared to the prior year, but importantly, this was pretty much expected.
Oh.
Yeah, it aligns with that normalization of market prices we've seen, something they've flagged before.
And supply and trading. How did that part of the business start the year?
That segment had a weak start to 2025. Q1 result was only 50 million euros, driven by lower trading performance in the quarter.
Okay, so definitely a mixed picture on earnings. Whether hitting offshore, growth helping onshore solar, flexible gen normalizing. Let's shift gears. What about the balance sheet? All this investment must be showing up there.
Oh, absolutely. You definitely see the impact of their growth strategy. Net debt increased to 15.9 billion euros by the end of Q1.
That's a pretty significant number. What's driving that increase?
Primarily, it's those massive net investments they're pouring into growing the core renewables, offshore wind, onshore wind, solar. They put 2.7 billion euros into CapEx just in Q1 alone.
2.7 billion. Wow.
Yeah. And beyond that, there were some seasonal things in operating working capital, like needing to buy CO2 certificates, and also some timing effects from hedging and trading that added to it. Adjusted operating cash flow was actually negative 1.15 billion in Q1.
Negative cash flow.
Yeah. But again, largely tied to those seasonal working capital needs and the big investments.
So it sounds like the higher debt and negative cash flow are directly linked to funding that growth.
Precisely. That's the story they're telling. And crucially, management reiterated confidence that net debt will actually be lower by year-end than it was at the end of Q1.
Oh, okay.
They expect it to land slightly below their target of 3 times leverage for 2025. So that points to maybe around 14 billion euros by year-end based on their guidance. That's a key point for anyone watching their balance sheet health.
Definitely. Now, besides investing in assets, they're also doing that share buyback program, aren't they? How's it going?
Yep, the 1.5 billion euro share buyback is underway, and they said it's right on track.
Yep.
The first 500 million euro tranche, they expect that to be done by the end of May 2025. Then the second tranche starts soon after. The whole thing should wrap up by May 2026.
Okay. And they also mentioned some portfolio optimization, selling off stakes in projects.
Yes, they successfully sold a 49% equity stake in 2 big offshore projects, the 1.6 GW North Sea cluster and the 1.1 GW Thor project.
And did they get a good price?
They characterize it as an attractive valuation, yeah. The agreed purchase price is around 1.4 billion euros at closing, which they expect by the end of Q2 2025.
And what's the significance of that deal?
Well, it massively reduces their share of the required net cash investments for those huge projects by around 4 billion euros. So it's a smart way to manage that big CapEx pipeline while still keeping a major stake in involvement.
Makes sense. Speaking of that pipeline, can you give us an update on what's actually being built right now? What's moving towards completion?
Definitely. Construction's humming along across various technologies. In the UK, the 1.4 GW Sophia project, that's on track for commissioning in 2026.
And when might we see power from that?
They expect first power in the second half of this year. And Sophia has a 15-year inflation-linked CFD, a contract for difference.
Right, which gives them stable revenue.
Exactly. Very predictable. Then in Denmark, offshore construction just kicked off on the 1.1 GW Thor project.
Yeah.
They're working on sorting out the power purchase agreements, the PPAs, ahead of its expected CO, commercial operation date, in 2027.
And back home in Germany?
The 1.6 GW North Sea cluster, that's in the German North Sea, planned for commissioning in phases 2027 and 2029. Installation is actually set to start this summer.
Also signing PPAs there.
Yep, like Thor, they're actively signing PPAs ahead of SKU. They've already got contracts for 400 MW of that capacity locked in.
What about onshore? Still busy there.
Oh yeah, onshore wind and solar is moving fast. They commissioned 500 MW just in Q1 alone. And a key point here, they have over 95% offtake secured, meaning the contracts to sell the power for both the stuff that's already running and what's still under construction in this segment.
That's strong. And batteries. Energy storage is huge now.
Absolutely, a huge focus for them. They just commissioned a 220 milliW battery system in Germany.
Okay.
And they've got another massive 1.4 gigaW under construction across Germany, the UK, and the Netherlands. And importantly, they specifically said these are on time and on budget.
It's good to hear. Okay, so that covers the numbers, the balance sheet, the pipeline. Mm-hmm. But these analyst calls, they're also crucial for getting management's read on the bigger picture, the market regulations. What key themes popped up in the Q&A?
Right. This is often where you get the really forward-looking stuff. A really significant topic was the German gas buildout.
Ah, yes. Why is that such a big deal for RWE specifically?
Because they could be a major player in building those new hydrogen-ready gas plants. Germany needs to back up all the renewables as they phase out coal by 2030.
Right.
RWE basically reiterated they're ready to go, ready to construct at least 3 kW of new capacity if the right conditions, meaning, supportive government policies and mechanisms are put in place.
And are they acting on that?
They are. They noted they've already secured supply chain access and turbine slots for 2.4 GW of that, and they've kicked off the permit application process too.
Wow, so they're really leaning in. Do they sound confident the government will actually, deliver the framework they need?
They do sound pretty confident. They see the new German government, especially the economic ministry, really prioritizing this. They express confidence that a pragmatic solution involving Brussels, too, will be found relatively soon.
Interesting. Did they mention potential costs? Because there's been talk about how expensive these new gas plants could be.
Yes, and RWE offered a really notable contrast here. Some competitors have suggested CapEx costs might be around, say, 2 billion euros per gigawatt.
Okay.
But RWE indicated their secured contracts are actually more in line with 1 billion euros per gigawatt.
Oh, wow, that's half. That suggests a potential cost advantage if they move forward.
Exactly. They anticipate getting clarity on the support schemes and maybe the first auctions for capacity by the end of this year or perhaps early next, driven by that critical need for capacity by 2030.
Another hot topic that always seems to come up is zonal pricing. What was RWE's take on that for Germany and the UK?
Yeah, they came out very clearly, very strongly against mandatory zonal pricing in both markets.
What's their main argument?
Their core argument is it just adds significant investment uncertainty, which is the last thing you need when you're trying to encourage massive investment in the grid and renewables.
Makes sense.
In the UK, they pointed out almost the whole industry opposes it, apart from one player. In Germany, they felt recent studies pushing it didn't really properly account for the grid buildout that's already planned or the potential negative impacts on, market liquidity and future PPAs. And they thought the calculated benefits seemed pretty minor.
So their preferred solution is just build the grid faster, not split the price zones.
Exactly. Accelerating grid build-out in both countries, that's the path they advocate for. Now, while they don't like the uncertainty these discussions create, they did note their UK assets are maybe slightly better positioned geographically, being further south. But in Germany, they don't actually expect changes, mainly because the current coalition agreement favors keeping that single price zone. But a key point they made, especially for the UK, they need clarity or some kind of indemnification on zonal pricing before they can bid in the upcoming UK AR7 auction.
Right, the UK offshore market has faced some bumps, project cancellations, tough auctions like AR5. How's RWE viewing that landscape now, especially with AR7 on the horizon?
Yeah, they definitely see a bit of an easing maybe in the broader European offshore scene. Fewer projects may be coming to market for sale. Some competitors, including some oil majors, seem less bullish or are shifting capital elsewhere.
Interesting.
RWE believes their own strategy, being cautious, applying really strict investment criteria, has been the right call in this environment. For the UK specifically, they basically stress that if the government seriously wants to hit its offshore targets, AR7, the next auction, has to be designed properly. It needs to allow enough capacity to actually clear, acknowledging the issues in AR5 where nothing cleared, and AR6 where success was limited and one big project was later canceled.
So are they ready to bid?
They said they're ready to bid and build their projects if the terms are appropriate, but again, reiterating that need for clarity on zonal pricing first. And crucially, they stated very explicitly that if their projects don't clear in AR7 because of pricing or lack of clarity, it would not automatically trigger an impairment risk for their existing UK leases.
That's a strong statement. Shows they value those sites long term.
It does, regardless of the immediate auction outcome.
Okay, switching continents.
Yeah.
Any insights on the U.S. market? Especially with things like the recent IRA draft proposals.
Yeah, they're analyzing those draft proposals from the House Ways and Means Committee. They see it as generally promising. Don't expect it to really change their near-term strategy or capital allocation plans much.
Right.
But they are applying more scrutiny to U.S. investments right now, only moving forward if key things are locked down. Safe harbor is in place, tariff risks are dealt with, permits are secured, and importantly, the offtake contracts are signed.
Makes sense. Due diligence.
Exactly. They're also looking closely at that foreign entity of concern clause in the draft legislation, but for now, they don't see it impacting their current supply chain positions.
Were there other regulatory discussions focused on Germany beyond the gas plants?
Yes, a bit. There was talk about a consultation on grid structure, including some ideas floating around about maybe generators paying for grid access.
How did RWE react to that?
They viewed it as, okay, a valid start to a dialogue. They think it points towards needing more work on demand flexibility and potentially introducing capacity payments to incentivize the right behavior and also address overall system affordability. So they appreciate the discussion starting, even if they have some different opinions on the specific proposals.
Okay.
And they also specifically flagged the need for a proper capacity market concept for the existing flexible generation fleet in Germany. Not just the new builds. They noted this is a longer process, but ideally should get picked off soon after the focus shifts from the new capacity build out.
Let's circle back quickly to that Q1 trading performance. You mentioned it was weak. Did management offer any more explanation or reassurance?
They did. Management basically characterized that Q1 trading result as, one of those quarters. They were quite firm, saying there are no structural changes in the market or their trading business causing it.
So not a trend.
Exactly. Therefore, they see no negative read across for the rest of the year. They remain confident in the full year guidance for the segment. Sounds like they just see it as a bit of short-term volatility, nothing systemic.
That's helpful context. Any discussion around German power demand? It hasn't exactly been booming.
Yeah, they didn't focus on it heavily in the prepared remarks, but management did express some hope. They think maybe improving investment sentiment, potential economic growth from government programs perhaps, could lead to an inflection point in German power demand.
When might that happen?
They speculated maybe starting around 2026 or 2027. The underlying idea is as industry decarbonizes, it will naturally boost demand for green power, which plays right into their strategy.
Makes sense. Okay, one last area, capital allocation choices, and also that phase-out technology business like their old lignite plants.
Right. On capital allocation, they acknowledged shareholders sometimes have mixed views, share buybacks versus investing in more growth projects.
The eternal debate.
Pretty much. They were clear that the decision on future buybacks after this current one ends in 2026 will depend on comparing the investment opportunities they see then, attractive projects, favorable environment, against what the share price is doing at that time.
So a dynamic decision.
Exactly. And any extra cash from things like asset sales, like the Amprion deal or farm downs, would just get factored into that overall capital allocation picture. For the phase-out segment, they stuck to their guidance for negative cash flow this year.
Okay.
They mentioned Q1 included one asset being unavailable, plus spending on recultivation, restoring the land after mining. They did clarify, though, they aren't running individual assets within that segment at a cash loss, and they expect the costs there to improve over time.
All right, let's switch gears now for our final segment. We like to end these deep dives with a little thought experiment. Taking everything we just heard and spinning out an outrageous but plausible trade idea, just for illustration, thinking about the implications. Absolutely not financial advice, okay? High risk involved here.
Okay, let's do it. Consider this. RWE was incredibly direct about their readiness for that German gas buildout, right?
Yeah, very clear.
They've got supply chain sorted, turbine slots booked, permits started, and potentially better pricing than peers. Management sounded genuinely confident the German government is serious, and a framework is coming relatively soon, maybe year-end, early next, driven by that hard 2030 coal deadline. They even brought up the need for a capacity market for existing plants right after the new build rules are sorted.
Okay, so where's the outrageous angle for an idea based on that?
The outrageous but plausible idea could be you bet aggressively on RWE's flexible generation segment and therefore potential upside in RWE share price, specifically because you're wagering that the German government actually pulls it off, that they deliver that pragmatic, quick, supportive framework on schedule.
Right, betting on government efficiency.
Exactly. That's the outrageous part. If they do, RWE could rapidly make final investment decisions on 3+ GW of modern hydrogen-ready capacity, maybe with that cost advantage. This capacity then earns money from the energy market and potentially from a brand new German capacity market. It's a direct bet on regulatory execution, unlocking significant value that's currently uncertain. But yeah, betting on government timelines and effectiveness. Notoriously tricky. Huge political and market risk.
A really interesting thought experiment, though. Directly linking potential government action based on the company's own commentary to possible valuation changes.
Purely hypothetical, high risk, and derived only from what was said on the call.
Got it. So to wrap up this deep dive into the RWE Q1 2025 call, we saw a solid start to the year, even with those tough wind conditions offshore. Management sticking by their full year guidance.
Yep. We dug into the segments, saw onshore solar growth and stable, flexible gen helping offset the offshore weather hit. Trading had that weak start, but management's calling it a one-off.
We looked at the balance sheet debt up, but tied directly to that heavy growth investment. The pipeline is active across offshore, onshore, solar, batteries, and they're optimizing smartly with things like the farm down.
And we covered that crucial investor context from the Q&A. Got management's clear views on the German gas build-out, their strong stance against zonal pricing, how they're navigating the UK offshore and US markets, and their thoughts on German market design going forward.
And remember, all this analysis is based purely on the information shared in RWE's conference call.
And just to hammer home one last time, nothing discussed here, especially that final trade idea segment, should be taken as financial advice. We're just pulling out the key takeaways and potential implications as the company presented them.
We really hope this deep dive gives you a valuable and efficient summary of RWE's first quarter and their outlook. What stood out most to you after hearing about their performance and management's views on these key market shifts? It's worth considering how these pieces fit into your own understanding of the fast-changing energy landscape.